I want you to imagine the sound of a market holding its breath. In the early hours of the morning, as Washington fell silent under a federal shutdown, crypto woke up to a different kind of noise, the hum of risk recalibration. When regulators furlough staff, data stops flowing, and policy timelines slip, liquidity doesn't just thin, it second-guesses itself. That is the stage we walk into today, and it's where the next moves in digital assets will be written. A government shutdown is never just a political story. It is a sequencing machine for capital. With the U.S. suspending parts of its regulatory apparatus, pipelines that normally carry official economic prints, ETF decisions, and enforcement signals are suddenly constrained. Investors have to price uncertainty in real time, and markets that live on information react to the absence of it almost as strongly as to bad news. That's why, even as some traders rotated into perceived hedges and momentum pushed the major coins higher intraday, the deeper question wasn't whether prices bounced, but whether the conditions for sustained trend formation still exist when policy is on mute. The immediate channel of transmission runs through regulators. When a main market cop steps back to a skeleton crew, the backlog grows, approvals, listing decisions, and staff-driven reviews slow down. That puts the spotlight squarely on one of the year's biggest structural shifts for crypto, the expansion of exchange-traded access. In the weeks leading into this moment, rule updates created a simpler path for new spot crypto ETFs to list, pushing the market beyond a world dominated by Bitcoin and Ethereum into a multi-asset paradigm that could include Solana, XRP, and others. If that tap is temporarily tightened by a shutdown, the timeline stretches, not the destination. But in a market where narrative velocity matters, any delay means rotations stall, liquidity pockets dry up, and relative strength reshuffles. Meanwhile, the institutional rails keep extending. A large U.S. broker-dealer platform moved to enable crypto trading via an infrastructure partnership, mapping out a 2026 launch for Bitcoin, Ether, and Solana. This kind of plumbing matters precisely during policy lulls. It signals that the old walls are still coming down, even if the gatekeepers are out for a day. Elsewhere, on the monetary side of the ecosystem, stablecoins continue to industrialize. A euro-denominated consortium formed by major European banks is preparing a regulated instrument that would sit directly in the payment stack, while the largest dollar-pegged stablecoin issuer explores a landmark private placement at a $500 billion valuation mark. Together, these moves say something simple. Regardless of U.S. political noise, the monetary internet is being built. Flows corroborate the shift, and it stumbles. Dedicated digital asset products swung from heavy inflows following a central bank pivot to outflows as macro tightened and uncertainty rose. Beneath the top line, the composition of those flows is telling. Bitcoin and Ether remain anchors, but Solana and XRP have started attracting meaningful institutional interest in select weeks, hinting at what a broader ETF regime could do to altcoin leadership once the policy spigot reopens. The shutdown doesn't erase that story. It pauses it, and sometimes a pause is enough to change who leads when the music resumes. Now let's talk about the assets one by one, because in a regime like this, dispersion is the whole game. Start with Bitcoin. In every policy shock, Bitcoin is both barometer and ballast. It absorbs the first punch when liquidity gaps open in derivatives, then finds buyers as a macro hedge narrative reasserts itself. Today is no different. The path forward hinges on two forces pulling in opposite directions. On one hand, reduced regulatory bandwidth and delayed data complicate rate cut timing, limiting the oxygen for risk assets. On the other, the broadening of spot product access and the continuing march of balance sheet adoption reinforce Bitcoin's structural bid. Technically, the market is fixated on whether spot can defend the mid-$100K support shelf and rotate back toward the $120,000 zone on improving breadth. If the shelf holds and ETF inflows resume post-shutdown, a measured trend rebuild is credible. If it breaks on thin tape, the next leg is not about fear, it's about forced flow, and the air pocket below is wide. Ethereum sits at the intersection of policy and productivity. Fee compression and competition have tightened the fundamental picture at times. Yet the network's role as a settlement hub for roll-ups, tokenized treasuries, and programmatic finance keeps deepening. In an environment where regulators step back temporarily, Ethereum's cadence becomes more about developer shipping than headline catalysts. The near-term risk is that delays in product approvals defer capital that would otherwise ladder into ETH exposure alongside BTC. The opportunity is that pipeline announcements in scaling, parallelization, and institutional tokenization continue to stack, reinforcing the case that every time policy catches up, Ethereum stands ready as the default operating system for high-value transactions. Price-wise, the battleground is whether ETH can maintain a constructive higher-lows structure versus Bitcoin on weakness, setting the stage for relative strength when the data calendar returns. XRP is the paradox of this cycle, the coin that trades like an alt yet increasingly behaves like infrastructure. Periodic drawdowns haven't erased its core use case in cross-border settlement and institutional rails, and the prospect of packaged exposure via multi-asset products has pulled new eyes to the ticker. The shutdown's practical risk is a postponement of issuer timelines and listing mechanics. Less about theory, more about paperwork and staff hours. Strategically, none of that changes a trajectory where faster, cheaper corridors are in demand, especially as banks and fintechs seek compliant ways to move value across borders. If broader spot access for XRP becomes normalized after the policy pause, the bid can pivot from episodic to programmatic, and that's how multiple expansion happens in this market. Solana is the high beta engine everyone loves to fight about. In stress, it sells off harder. In recovery, it outruns the pack. The pipeline for new vehicles that explicitly include SOL is one of the most important unlocks for its institutional phase, because it converts social and builder momentum into allocatable wrappers. The shutdown threatens to clip that timing at the edges, but the architectural story, throughput, experience, consumer-grade UX, doesn't wait on a government calendar. The real question is whether network reliability under peak load continues to improve, because that's what translates hype into habit. If flows re-accelerate into Solana products after the pause, the asset has room to surprise to the upside as a designated growth L1 in professional portfolios. Dogecoin is the sentiment gauge that refuses to retire. It swims where retail energy swims. And while that makes its fundamentals harder to quantify, it also means that during policy-driven uncertainty, Doge functions as a pure expression of risk appetite. It is unlikely to benefit directly from a more sophisticated ETF era in the same way BTC, ETH, SOL, or XRP might, but in a rising tide scenario that follows a shutdown resolution and macro clarity. Dogecoin often captures second-order rotation as traders chase momentum. If you treat Doge as a volatility proxy rather than a cash flow asset, the signals to watch are breadth, funding normalization, and whether beta chases leadership once policy restarts the news cycle. Cardano remains the long-duration experiment, and this is the kind of macro week that tests conviction. The thesis for ADA has never been quick catalysts. It has always been method, peer-reviewed upgrades, and a drive toward predictable, secure smart contract infrastructure. The practical risk of the shutdown is less about ADA specifically than about the temporary freezing of attention on everything that isn't an immediate headline. Paradoxically, those are the windows where projects that build quietly can gain ground. If capital rotates back into multi-asset products post-pause and on-chain usage ticks up across identity, DeFi, or interoperability initiatives, ADA's asymmetry improves. If the market stays in a liquidity-scarce, headline-driven regime, ADA's carry is patience, not velocity. Zoom back out, and a strategic map comes into focus. ETFs will become the main rails for regulated exposure in the US, with or without a one-week detour. Brokerages enabling direct access will keep eating the frictions that used to keep retail and advisors on the sidelines. Stablecoins are graduating from crypto tools to bank-grade payment instruments, with Europe's initiative and large private raises signaling a future where fiat on-chain is not a fringe convenience, but the plumbing. Dollar dynamics remain the wild card. A softer dollar on weak labor prints tends to lift hard assets, but if a prolonged shutdown keeps data dark and delays central bank signaling, risk premia rise across the board, and that's when only the highest conviction narratives keep their bids. What does that leave us in practice? In a market of pauses and resumptions, information edge becomes timing edge. Watch for when regulatory teams resume full operations and decision clocks restart. Track ETF flow imbalances between Bitcoin and the new cohort. Follow stablecoin issuance and chain-level settlement growth as a proxy for real usage. Price will move before press releases, but the scaffolding for the next leg higher, or the warning signs for another flush, will show up in those pipes first. Above all, don't mistake silence for safety or for danger. In crypto, silence often precedes sharp movement because liquidity compresses and narratives reprice quickly. The shutdown turned the volume down on policy, but it turned the contrast up on strategy. The projects aligned with deep, regulated access, scalable rails, and actual payment or settlement utility will exit this pause stronger than they entered it. The rest will keep chasing a spotlight that isn't coming back. When Washington flips the lights on again, the market won't go back to where it was. It will go forward to where the rails are pointed. And right now, those rails are unmistakably pointing to a more institutional, more integrated, more programmable financial system, with Bitcoin and Ethereum anchoring it, Solana and XRP accelerating it, Dogecoin measuring its temperature, and Cardano reminding us that credibility still comes from shipping. That is the frame for the weeks ahead. The shutdown is the story of the day. The build-out is the story of the decade.